Welcome to part 2 of our non-current long-term liabilities reading. Okay, our first learning outcome here asks us for the motivations. Explain the motivations to lease assets rather than purchasing them outright. So the idea is either we lease an asset or alternatively we borrow the funds and buy an asset ourselves. Well, number one, maybe we don't want to use the asset for its entire life, so it makes sense to lease it if the period of use is shorter than the asset's life. Cheaper financing. It may well be cheaper to lease an asset than actually borrowing cash, essentially raising debt and actually purchasing an asset. No down payment. Typically we don't have to pay anything up front essentially when we lease an asset. Fixed rates. Yes, essentially when you lock into a lease, you're looking into paying a fixed rate of interest over the lease's life. And that might be attractive for firms that can't issue fixed coupon debt, essentially are reliant on floating rate loans, for example. We may well find that leases have fewer or no covenants compared to bonds, so we might be able to avoid covenants. Less risk of obsolescence. Well, it's not our asset at the end of the day, so at the end of the day it goes back from the leasee to the lessor. So remember, the lessor is the person who legally owns the asset. The lessee is going to be the person who uses the asset. So at the end of the asset's life, the asset goes from lessee back to lessor. Potential financial reporting advantages. Well, here we're talking about operating leases. Huge advantage here because there is no backup balance sheet recognition of either asset or liability. So we're talking about off balance sheet, of course, finance in this case. That is finance, you'll have to trust me on that. Okay, so an operating lease, a big source of off-balance sheet finance. They also mention some certain tax advantages, in particular synthetic leases. Now this is a bit of a US phenomenon. This is when you structure a lease. So for accounting purposes, you have no recognition of asset or liability, but for tax purposes you do. So what that means essentially is depreciation is tax allowable on the asset and saves you tax in the tax returns, but there's no asset or depreciation in the financial statements. So just be a little bit aware of that. So let's look at distinguishing capital versus operating leases. And again, just be a little bit aware that a finance lease can be referred to as a capital lease or vice versa, essentially the same thing. So let's have a look at IFRS first of all. Both the lessee and the lessor must account for a lease as a finance lease if substantially all rights and risks of ownership are transferred. In other words, it's almost as if the lessee has bought the asset from the lessor. All the rights, risks of ownership transferred from lessor to lessee. But notice there are no actual quantitative criteria, no numeric criteria that we use under IFRS. Now let's contrast that to US GAAP. Now you can see with US GAAP we've got some set quantitative criteria here. So notice under US GAAP the lessee must report as a capital lease if any, notice it's any, it's not all, it's if any one of the following criteria are met. So number one, title transferred to the lessee at the end of the lease. So this is really what we would often refer to as a hire purchase agreement. When you make your final payment, then the legal title, ownership in other words, transfers from lessor to lessee. A bargain purchase option exists. This gives the lessee the ability to buy the asset that they've leased below its fair value at the end of the lease. And then 3 and 4, and these are the ones that I think again are going to be really critical to remember for the exam. So number 3, that you're leasing the asset for 75% or more of its economic life, its useful life. And number 4, the present value of the lease payments are greater or equal to 90% of the asset's fair value. So in other words, what we're really simply saying here is, look, the present value of what we're expected to pay is almost the same as the value of the asset that we're leasing. Now again, it's only one criterion that we need to meet. Okay. Now notice, for the leaser, it's a capital lease if one of these criteria are met and is performed substantially and payment is reasonably assured. So again, the customer is expected, the lessee is expected to pay us the rental payments when they fall due. Again, otherwise it would be difficult to record an asset. Okay, so those 4 criteria are absolutely vital for your exam. Make sure you know those going into it. So finance lease, key point is we're trying to create the illusion here that we've borrowed money and used that borrowed funds to purchase an asset. So we are going to have recognition of an asset and we are going to have a recognition of a liability. Because we recognize both an asset and liability, it leads to some candidates to get it slightly confused. Now be aware that the asset and the liability will equal one another right at the start of the lease and right at the end of the lease, but they do not need to equal one another during the lease, and we'll see why in just a second. Okay, now notice we're going to record essentially an asset and a liability at the lower of fair value or the present value of future lease payments. So the asset's fair value or the present value of future lease payments. Now again, typically I would expect the present value of future lease payments to be less than fair value. But if for some reason fair value was lower, then remember you use the asset's fair value. Reported on the balance sheet as both an asset and a liability. So both we record an asset and a liability at the same monetary value, keeping the balance sheet balanced. Now, as I said, the only time the asset and liability need to equal each other are right at the beginning when they're created and right at the end when they're extinguished. During their life, they do not need to equate to one another. They're going to have their own sets of double entry applied. So for the asset, we're going to depreciate it over time, just like assets we purchased. So it's going to be depreciated over time. Just be careful. We should depreciate it over the life of the lease, which of course may be different from the useful economic life of the asset. So the asset might have an 8-year life. You're leasing for 6 years. Make sure you depreciate over 6 and not 8 years. Now, interest is going to be charged on the liability. We're going to amortize a bit of interest on the liability. So every time we make a payment, part of that payment is going to be paying down principal. Part of that payment is going to be paying off interest on the liability. So look, notice we're saying it's rather similar to amortizing debt, splitting the payment between interest and principal each period. Okay, let's get straight into an example for a finance lease. So here we've got a firm leasing an asset for 3 years, payments $10,000 per year, straight line depreciation, no salvage value, lease discount rate 7%, fair market value 27,000. So our first thing is we need to, of course, work out the present value of those 3 lots of 10,000. Now again, unless we are told that payments at the start of each year, I think it's fairly safe in our exam to assume payments arise at the end of each year. So what we're going to do essentially is just quickly compute those. So N is 3, IY, our discount rate is 7%, payment of course is 10,000, future value, notice our future value here, 0. We don't own the asset. It's the lessor that owns the asset, not the leasee. So at the end of the lease, we're not going to be able to scrap the asset. So future value is typically going to be 0. Compute the present value and we get 26,243. Notice that is lower than the fair market value. So we're going to record the asset and the liability at 26,243. So we're going to create an asset of 26,243. We're going to create a liability at 26,243. We're going to use the lower, as we mentioned. Okay, so let's have a look at both our what's going to happen to our asset and our liability. Initially, of course, at the start of year 1, there's the liability, 26,243, and actually the book value of the asset, this column, our final column here, book value of the asset, what we're actually seeing is the value at the end of each year here. So actually at the start of year 1, you'd have an asset at 26,243 as well. Now, rather like our bonds, when we were accounting for bonds, we then take the interest rate, in this case the interest implied in the lease was 7%, and apply it to the opening liability. So our interest expense is opening liability times the interest rate, so 26,243 times 7%, and that gives us 1,837. Now, we then at the end of the year make our first payment of 10,000. And we're going to argue that 1837 is interest, and therefore the balance of the amount is going to be principal. So 8,163 is paying off principal. Now, what that means, therefore, is our liability falls not by 10,000, but instead falls by the principal repayment of 8,163. Let's just check that out. 26,243 minus 8,163, and that gives us our closing liability value there of 18,080. Or again, if you like, what you can do is take the beginning value, add the interest, and subtract the payment of 10,000, and you end up at 18,080 as well. Again, be aware that if you've got the cash flows in on your future value buttons, your present value buttons, time value money buttons really, third row of the calculator, then you can use the amortization function on the BA2 Plus to work out interest expense, amortization, etc. Okay, so notice therefore at the end of the first year our liability value 18,080. Now for the asset, of course, that's going to be depreciated. So straight line zero salvage value, so there is the gross cost of our asset, 26,243, divided by the life of the lease, 3 years, meaning 8,748. So the closing book value at the end of year 1, 26,243 minus 8,748, giving us 17,495. Remember, the carrying value of the asset is always going to be historic cost less accumulated depreciation. So note, therefore, that look, our asset and liability do not equal each other at the end of the first year. They did at the beginning, 26,243 for the liability, 26,243 for the asset, but not at the end. Okay, so let's have a look at year 2. Liability at the end of year 1, beginning year 2, 18,080. 7% of that, 1,266. We then make a payment. And again, of that payment, we're saying 1,266 is interest, and therefore the balance of that payment, so 10,000 minus 1,266, in other words, 8,734, is of course principal, and therefore the liability falls by the amount of the principal payment. So 18,080 minus 8,734, and that gives us our year-end balance of 9,346. Notice now, of course, for the asset we've got 2 years of straight line depreciation, so 8,748, 2 years of that, so times 2, total depreciation now 17,496. So 26,243 less 17,496, and that gives us our carrying value of 8,747. Okay, now final year, end of year 2, beginning of year 3, there's our liability sitting there at 9,346. 7% of that gives us our interest expense of 964. Our 10,000 payment, 654, of course, is interest. The balance, which of course is 9,346, is paying off the principal. The liability, 9,346 at the start of the year. We pay off principal of 9,346. So our liability at the end of the year, of course, is 0. We're now at the end of the term of the lease. 1 more year of depreciation, bringing the carrying value of the asset down again to 0. Remember, depreciating all the way down to 0 because the scrap value is essentially 0. It's not our asset. So as we said, the only time that the asset and liability need to equal each other is right at the start when they were both 26,243, and right at the end when they're both 0, but not during the life of the lease. Now, one added complication. Let's say we're at the beginning of the lease's terms. We calculated the present value of the lease payments to be 26,243. When we look at the balance sheet, we're not going to see 26,243 anywhere. Why? Well, essentially because it's going to need to be split between current liabilities and long-term liabilities. So in fact, when we look at that 26,243, we're going to find that the principal payment in year 1, and we calculated that at 8,163, so the 8,163 is going to be sitting in current liabilities, and of course the 18,080 is going to be sitting in long-term liabilities. 8,163 plus 18,080 being 26,243. So be aware, each year we've got a split between current liabilities and long-term liabilities. Likewise, at the beginning of year 2, there's going to be a split of that 18,080. We'll find that 8,734 is in current liabilities and the 9,346 is in long-term liabilities. Finally, in the last year, of course, the full 9,346 would be sitting in current liabilities. So be aware that you need to make that split between current and long-term liabilities. Let's have a look at the implications on our cash flow statement. Now notice what passes through cash flow from operations is the interest element. The 1837 in year 1, the 1266 in year 2, the 654 in year 3. Notice the interest element is declining over the life of the lease. And now the reason for that, of course, is the liability is getting smaller as we pay off principal. Notice the cash flow from financing, the principal payment, well, of course, this is just the flip side. Now, again, remember, together, the interest element and the principal element have to add up to our payment of 10,000. So, essentially, the principal payment was 8,163 in year 1, 8,734 in year 2, 9,346 in year 3. Now let's compare this to an operating lease. Now if we deem a lease as an operating lease, there will be no recognition of asset, no recognition of liability whatsoever. All that happens is every time we incur a rental payment of 10,000, down will go our cash by 10,000 and we'll record a rent expense in the income statement of 10,000. And it will all pass through cash flow from operations. So of course, one very big advantage we have for the finance lease is our CFO will be higher. That's pretty much the end of the advantages for finance leases over operating leases. Typically for everything else, things like leverage in particular, an operating lease is going to be far preferable. Okay, now let's have a look at our expense in the income statement under a finance lease. Notice our expense has two components, the interest element and the depreciation. Whereas in the operating lease, it is the rental expense. Now what we're going to tend to find with a finance lease is interest plus depreciation together is greater than the rental expense in the earlier years, but less in the later years. So we're going to find in total the same amount, in this case we had a 3-year lease, 10,000 a year, so 30,000. The same amount, 30,000, will pass through the income statement over the life of the lease. But we would expect to see more hitting the income statement in the earlier years under a finance lease and less in the later years. So we've got a bit of a timing difference with operating leases as well. Now again, just to illustrate essentially the impact on the income statement between your finance lease and your operating lease, here I've set it out. Look at let's take our operating lease first of all. It's fairly straightforward. The amounts hitting the income statement each period, 10,000, 10,000, 10,000, i.e. the rental expense, giving us a total of, as we said, 30,000. So the total, 30,000. Now, when we turn our attention to the finance lease, the two elements going through are interest and depreciation. Now we're using straight line depreciation, so that's relatively constant over the life of the lease, but of course the interest element isn't. The interest element is going to decline as the liability falls. So notice in year 1, interest 1837, depreciation 8,748, giving us a total income statement expense of 10,585. So notice, compared to the operating lease, our expense is $585 higher under the finance lease. Now, of course, if our expense is higher, then our net income, our retained earnings, our stockholders' equity is lower in year 1 under the finance year lease. In year 2, let's have a look. Interest expense 1266, depreciation 8748, giving us a total of 10,014 compared to the operating lease of 10,000. Notice this time it's $14 bigger. So again, net income slightly lower, equity slightly lower under the finance lease. But that's all going to reverse, of course, in the final period. So in the final period, of course, notice the interest now 654, the depreciation 8747, so a total of 9,401 going through the income statement under the finance lease, compared to, of course, 10,000 going through under the operating lease. Therefore, this time our net income is going to be $599 higher under the finance lease. Notice the totals going through under finance lease and operating lease over the life, 30,000. So we are just seeing a temporary timing difference being created by the finance lease here. So yes, in earlier years, there we go, in our earlier years, essentially higher expense under the finance lease, lower under the operating lease, but we're noticing, of course, that that is reversing in the later years. The finance lease gives us a lower total expense in the income statement than the operating lease. So let's determine the effects on our financial statements, which is what our learning outcome requires us to be able to do. So really we're looking at finance versus operating lease. Now, of course, under a finance lease, of course your assets are going to be higher because you recognize an asset. Under an operating lease, we don't. Second, of course, not only do we recognize an asset under a finance lease, we also record a liability. So no surprise, therefore, both assets and liabilities are higher under finance leases. Relatively, of course, under an operating lease, they are going to be lower because we have no recognition of balance sheet asset or liability. Okay, net income in the earlier years. Well, as we saw under a finance lease, net income in the earlier years is lower, but in the later years, of course, it is higher. And the total impact on net income over the life of the leased asset, well, that was exactly the same under both finance and operating. We saw a total of 30,000 went through in aggregate under both. Cash flow from operations. Now, here's the big area where the finance lease actually does boost your financial statements, because cash flow from operations will be higher because CFO only has the interest element passed through. Whereas under an operating lease, of course, the full rental payment passes through CFO. So you get a lower CFO under operating leases. Cash flow from financing, well, the principal element passes through here, so it's going to be lower under a finance lease. And of course, there's no impact on operating leases in terms of cash flow from financing. Total cash flow, of course, identical either way. Okay, we turn our attention a little bit to lessor. We've been looking at leasee, i.e. the person who leases the asset and uses it, but what about lessor? I have to say I'm less concerned essentially about lessor accounting. Again, if you think about it, every company uses leased assets, so virtually every company is a leasee, but not that many companies are going to be lessors. So I think master lessee accounting before you start to worry about lessor accounting. Okay, let's have a look. Under IFRS, the lessor repeats a lease receivable. Now notice, key point here, we should say, it is treated as if we're looking at a finance lease here. Again, from the lessor, we talk about operating leases and finance leases. If it's deemed to be an operating lease, the lessor keeps the asset in its balance sheet and continues to depreciate it and just shows the rental as income coming in. If it's a finance lease, essentially they're going to de-recognize the asset out of their balance sheet and instead show a lease receivable, which of course will be equal to the present value of the lease payments they're expected to receive. Now actually you can see it's a little bit more complicated than that. The lease receivable is the present value of the lease payments, but also the residual value of the asset. Because remember, the asset will transfer back from the leasee to the lessor at the end of the term's lease. So you're owed essentially in present value terms not only what the lessee is going to pay you, the lease payments, but also in present value terms the scrap value of the asset at the end of the lease term. Okay, so as we said, under IFRS, we are going to de-recognize the asset when we enter a finance lease, essentially. It's as if you disposed of the asset, so we've got to take it out of the balance sheet. And then, of course, those lease payments, as we receive them, part of them are going to be interest receivable, and part of them are going to be a return of capital. And, of course, the return of capital is going to pay down that asset over time. Now, if the leaser is not a manufacturer or dealer, then notice any initial direct costs are added to the lease receivable, which is going to reduce the interest component of any payments. Now, if we are a manufacturer or dealer, so this is slightly different. What we're saying is there's two different classifications of capital leases. Number one, if you're not a manufacturer or dealer, sometimes we refer to that as a direct financing lease. And number two, if you are a manufacturer or a dealer, in which case we often refer it as a sales type lease. Here, if you are a manufacturer or a dealer of the leased equipment, what we're saying is, look, it is part of your business operations to sell this equipment. So we're going to treat it as if you sold this asset. The sales revenue that you get is simply going to be the fair value of the lease payments that the lessee is going to pay to you. Okay, and we're going to compare that to the fair value of the asset to record a profit or loss up front. Okay, notice any direct costs of the lease setting it up are going to be expensed under this approach. The cost of sale is the carrying value of the asset, the fair value of the asset, minus the present value of what we believe the asset will be worth at the end of the lease term. So notice, and again I think this is the key thing to take away, you are going to recognise a profit up front at the time the lease is entered into. So with a sales type lease, we do recognise a profit up front, the rest will be interest receivable. With a direct financing lease where we're not a manufacturer or a dealer, no profit is recognised up front, it's all going to be interest receivable spread over the life of the lease. Okay, now again, you can see those phrases more common under US GAAP, direct financing lease and sales type lease. So it actually uses those phrases, whereas IFRS doesn't. Now again, if it's a direct financing lease, then you're a financing company. You don't manufacture or sell this leased equipment. You literally are a financing company. Customers come to you and say, can you purchase this asset for me and lease it to me? In which case, really, you're a financial institution, and therefore, all of the profit on this transaction should be interest income spread over time. If you are a manufacturer of the leased equipment, then a very different approach. It's the sales type lease. We are going to recognize a profit up front, okay? Again, by comparing the present value of the payments that we're going to receive from the leasee to the fair value of the asset minus the present value of its scrap proceeds to get a profit or loss up front. The balance will be interest income over the remainder of the lease. Okay, let's have a quick look at an example. So here we are. Roland's Incorporated is leasing a machine to haul. The lease qualifies as a finance lease. Terms of the lease are 3 years at $10,000 a year. We think that we can sell for $5,000 at the end of the 3 years. The fair value of the asset is currently $24,000. Okay, so we've calculated a rate implicit in the lease here, essentially a discount rate implicit. It's a 3-year lease, so N is 3. The payments we're receiving from the leasee are $10,000. The fair value is the scrap proceeds of the asset, $5,000. And the present value is the fair value of the asset, so minus $24,000, and then we can compute the internal rate of return, compute the yield, if you like, and get 19.897. Now, then let's have a look at the actual impact. Notice we're creating a lease receivable there at $24,000. The fair value of the asset is our lease receivable essentially there, $24,000. The interest income we're receiving on that, of course, $4,775. Again, if we want to compute that, 24,000 times our 0.19897, and that gives us our 4,775. So again, opening receivable times essentially your rate implicit in the lease. Rate implicit in the lease, I should say, gives you interest income. Payment 10,000, of course, 4,775 is our payment of interest within that figure. The balance, the 5,225, is the payment of principal from the leasee. So therefore our asset, the lease receivable, falls by 5,225 from 24,000 down to 18,775. Again, year 2, 18,775 times our rate implicit in the lease, 19.897, to get 3,736. Again, 10,000 being the payment. Part of that, the 3736 is interest receivable. The balance is paying off principal. So 6264 is the reduction essentially in what we're owed, and therefore the lease receivable falls from 18,775 down to 12,511. Final year, of course, beginning receivable 12,511. The interest income this year, again 19.897% of that beginning receivable, giving us 2,489. Take the payment, split it between the interest receivable, 2,489. The balance is paying off the principal owed by the leasee, 7,511. So notice, therefore, that at the end, 12,511 minus the reduction in the lease receivable, 7,511, gives us 5,000, which of course is the potential resale value of the leased asset. So what we're doing is we're reducing this asset down to scrap value or resale value of the leased asset, because of course that asset does return to us at the end of the lease. Okay, lease disclosure. So what are we going to need to put in the footnotes to our accounts? So notice both lessees and lessors have to describe the leasing arrangement. What is the asset being leased? What are the terms of the lease? In particular, and here's a key one, payments that need to either be made or received. Made, of course, if you're a lessee, received if you're a lessor, for each of the next 5 years. So separately for each of the next 5 years, and then aggregate payments falling due beyond 5 years. Okay. Notice as well, lease revenue and expense for any period, for each period. So what's going into expenses and what of course is going into revenues. Revenues of course only really applicable for the leaseor, expenses more applicable for the leasee. Notice as well amounts receivable and unearned revenues from leases. Now remember what an unearned revenue is. It's where the customer has paid you before you can recognize the sale, and therefore a liability needs to be created. And then finally also any restrictions imposed by lease arrangements, in particular any covenants built into those leases needs to be disclosed as well. Okay, so we now turn our attention to pension liabilities. Now this is a really tricky area of the syllabus, but there is some good news here. It's really a tricky area, but we don't really need to understand it in full detail until we get to the level 2 syllabus. So I think a lot of it's going to be a bit baffling at level 1, but hopefully it will become clearer at level 2. Now there are 2 types of pension that we look at in our syllabus. Defined contribution. Here your employer is just agreeing to contribute a fixed percentage of your salary into your plan each year. Now what that pays for on retirement is your problem. Now in practice this is completely simple, the accounting for these. Essentially the pension expense will be the employer's contribution each year. The balance sheet asset or liability will simply be, well, number one, if they fully paid up that year's payment, there will be no asset or liability. If they're due to pay into your plan but hadn't done it at year end, then you'd see a liability equal to the contribution that they're due to make. Okay, so lovely and straightforward. The only reason we could see an asset with a defined contribution plan is maybe if the employer had accidentally paid too much into our plan, which of course is rather unlikely. Okay, so that's defined contribution. Now we're asked to compare the presentation, the disclosure as well of both defined benefit and defined contribution. So income statement very simple, employer's contribution. Balance sheet very simple, typically nothing going to show up unless they fail to pay in our plan, in which case there could be a liability equal to the contribution they still owe. Now, the other type of pension plan is defined benefit. Now, my goodness me, if defined contribution was straightforward, then defined benefit is the polar opposite. This is absolute kind of accounting rocket science. This makes accountants cry, so here you are in your CFA syllabus hitting this. It is a tough one to understand. And as I said, we don't really give you the full picture until we hit our level 2 syllabus. Now, with a defined pension plan, your employer is agreeing to make fixed payments to you based on your retirement. And these payments are normally based on how many years you've worked to date and your final salary, essentially. So there is an agreement to make fixed payments to you on your retirement date. Now what that means is essentially the company has a liability. They have the liability because they're going to need to make these future payments. The company will also typically pre-fund this liability. So during your working life, they're going to typically pay into a plan, a portfolio of assets if you like, and then they're going to use these assets on your retirement to generate the cash flows they promised to you. Now this is going to be complicated. In our balance sheet, what we actually see is what we call funded status. We see the difference between the plan assets, and plan assets is just the market value of the portfolio of assets owned by the firm, compared to the estimated obligation. Now the estimated obligation is going to be the present value of the payments that they're expecting to make to us on retirement. Now this of course is going to be tricky to ascertain. What are the present value of the payments that are going to be made to you on retirement? Well, number one, they're going to need to work out the payments likely to be made to you on retirement. So they're going to have to estimate how many years you're going to live. They're going to have to estimate your final salary, etc. So it's a complicated calculation. And then once they've worked out the payments that you're likely to receive after retirement, they need to be discounted all the way back to the current point in time. So the estimated obligation, and US GAAP typically calls it the PBO, the projected benefit obligation. IFRS typically calls it the PVDBO, the present value of the defined benefit obligation. But in both cases, it's the present value of the payments that we're expecting to make to our retirees on retirement. Now, if the plan assets are lower than the plan liability, which of course is often the case, then we have what we call an underfunded pension plan, and we're going to show a balance sheet liability. If the plan assets are greater than the pension liability, then we have an overfunded plan, and of course we're going to show a net pension asset. Okay, a firm must estimate the present value of pension obligations based on future compensation levels, employee turnover, average retirement rate, mortality rates, and appropriate discount rate. In other words, trying to estimate this obligation is pretty tricky and is going to be difficult to do so. And of course, typically the firm is going to use actuaries to actually arrive at this data. Now, change in the net pension asset liability during the year. Just some phrases that we really need to be aware of. The service cost. Now, the service cost is the increase in what the firm owes you because you've worked for one extra year. So essentially, it's the increase in the liability caused by employee efforts during the year. Now, it's the increase in the benefits they're going to pay to you on retirement discounted back to the current date. So it's the present value of the additional benefits you've earned because you've worked one extra year. Past service costs. Now, again, if they change the terms and conditions of the plan, if they make it more generous, then the liability measure will jump, will increase. If they make it less generous, it will shrink. And these are known as prior service costs. Retroactive benefits essentially awarded typically when the plan is changed. The net interest expense or income. Now we're going to see net interest expense and income under IFRS. We'll see gross interest expense and essentially interest expense and income under US GAAP. So under IFRS, we net interest expense with plan income, essentially. The interest expense is really the expense on the liability. The plan liability increases each year simply due to the passage of time. Each year that passes, we're 1 year closer to retirement, and therefore the PBO under US GAAP, the PVDBO under IFRS gets bigger. This increase in the liability measure due to the passage of time is the interest expense. Now, of course, there's also some income element. The plan assets generate income. Now, we net the two against each other under IFRS, whereas the two are shown separately under US GAAP. This is because IFRS requires you to use the same rate of return for your interest calculation and the return on plan assets, whereas US GAAP actually allows you to use different rates. So net interest expense or income under IFRS can be calculated by taking the opening funded status, so beginning funded status, times our assumed discount rate. Actuarial gains and losses, sometimes referred to as remeasurement gains and losses. These are the gains and losses caused by changes in actuarial assumptions, such as the discount rate, such as the rate of salary increase. We get an actuarial gain, essentially, if it makes the pension liability shrink. We get an actuarial loss if it makes the pension liability increase. Also, again, the pension asset or liability will change by this year's actual return on plan assets. Okay, now again, this actually gives us another remeasurement gain or loss, the difference between expected return on plan assets and actual return on plan assets. Pension expense or other comprehensive income. What this is really saying is some of these items are going to go through the income statement, some are going to be taken directly to other comprehensive income. And essentially US GAAP and IFRS rather differ on what goes where. So let's try and talk about what hits the income statement and what goes directly to other comprehensive income. First of all, service costs. So remember, this is the increase in the PBO because the employees have worked 1 extra year. That goes to the income statement. And the net interest income and expense. Remember, there's really two components here. The interest expense on the PBO, on the plan liability, caused by the plan liability increasing due to the passage of time, and the interest and the income, which of course is the return on the plan assets. But because we use the same discount rate for both, they are netted against each other. In other words, the expected return on plan assets has to be the same as your discount rate under IFRS. So that interest income / expense that we're seeing here in point 2 is essentially interest expense net of any expected return on plan assets. Okay, and those are hitting the income statement, as we can see. What that means is our actuarial gains and losses, changes in the pension liability due to changes in our actuarial assumptions, they're going to go directly into stockholders' equity, as is the difference between the actual return on plan assets and the expected return. Notice essentially what's hitting the income statement within essentially this element here is essentially the expected return on plan assets. The actual return may actually differ. So the difference between actual return and expected return also goes to comprehensive income. So notice the actuarial gains and losses plus the difference in actual and expected return together are referred to as remeasurements under IFRS and taken directly into stockholders' equity, where they remain. Now, because IFRS has been very prudent, the discount rate used for the interest expense, calculating the present value of the future payments, i.e. calculating the liability, and the rate of expected return on the plan assets has to be the same, and IFRS requires them to be the yield on high-rated, AA-rated corporate debt. Fairly conservative. So we're making very conservative assumptions, and therefore the actuarial gains and losses and the differences between actual and expected returns are not amortized. They shouldn't grow substantially, and in fact, hopefully, because we're being prudent, they should reverse at a future date. Now let's turn our attention to US GAAP. First of all, what hits the income statement? Service costs, same as IFRS. The increase in the pension liability because we've worked one extra year. Second one, the interest expense. Now, notice here's the difference between US GAAP and IFRS. Under IFRS, we had the net interest expense or income. Essentially, we netted interest expense against expected return on plan assets. Under US GAAP, we are going to show the interest expense and the expected return on plan assets separately because we can use different rates of return for the two. Okay, so the interest expense again is the increase in the PBO due to the passage of time. The expected return on plan assets is the actuary's long run assumed rate of return on the portfolio of assets. These two, as we said, the rates of return, the percentages used can differ under US GAAP. They must be the same under IFRS, which is why IFRS essentially nets the two elements against each other. Past service costs. Now again, if we change the terms and conditions of the plan, under IFRS, past service costs immediately had to be expensed. Under US GAAP, past service costs hit other comprehensive income. They then get amortized over the remaining service life of the employees. Likewise, actuarial gains and losses. Now, US GAAP calls them actuarial gains and losses. IFRS calls them remeasurements. So they are essentially equivalent. So they are the actuarial gains and losses that affect the liability measure, but also the difference between actual and expected return. Actuarial gains and losses per US GAAP. They go to other comprehensive income, just like they did under IFRS, but here is the difference. They are going to be potentially amortized according to a 10% corridor. Now again, I don't want to get too bogged down in what do we mean by 10% corridors right now. Be aware, look, they are going to be amortized through the income statement essentially in future periods, potentially. Defined benefit reporting, if you're a manufacturing company, you're producing goods and services. Now, of course, your pension expense is going to be needed to allocate, or you're going to need to allocate between costs of goods sold and sales, general and admin. So any workers involved in the production process who are getting defined benefit pensions, well, of course, this is part of their remuneration package, so it needs to be included as a production overhead. Of course, if you've got employees that are not directly related in the production process, then their pension expense would be included in sales, general and admin. So again, be aware that we need to split by the function of the worker. Now we finish this little area up here by looking at ratios, and all we're asked to be aware of is the computation of some leverage and coverage ratios. Now again, of course, we've covered this earlier on. So let's start with our total debts. First off, definition of what total debt is. It is all of your interest-bearing liabilities, whether they are current liabilities or whether they are long-term liabilities. Debt to asset ratio, total debt over total assets. Again, I guess the argument is you want this ratio to be lower than 1. You'd like the assets to be higher than the debt so you could pay off the debt if needed by liquidating assets. Debt to capital ratio, which essentially is balance sheet debt over balance sheet debt plus stockholders' equity. So here what we're seeing is the percentage of debt used in our capital structure. So if the debt to capital ratio comes out at, let's say, 60%, the implication is 60% of your capital structure is debt, 40% must be equity. The debt to equity, just long-term debt over stockholders' equity, it is just a pure ratio. And then we have the financial leverage ratio, otherwise known as the financial leverage multiplier. Average total assets over average total equity. Why have we used average even though both components are from the balance sheet? Well, the place you're most likely to see the financial leverage is within DuPont analysis. And of course, remember, DuPont analysis essentially breaks down return on equity, which of course is net income over equity. And what DuPont does is it takes that ratio and splits it out. Now notice ROE is a mixed ratio, so when we look at balance sheet items, typically they're mixed as well. Basic idea with the financial leverage ratio is if you are purchasing assets using equity, the ratio should be close to 1. As soon as you start to use debt to purchase assets, asset goes up, but equity doesn't, the ratio starts to climb above 1. Right, then to finish our area, we're looking at a couple of coverage ratios here. The interest coverage ratio, EBIT over interest payments. It's a safety ratio. It's looking at how comfortably you're meeting your current interest payments out of your profit before interest, earnings before interest and tax, EBIT. Okay, now fixed charge coverage ratio looks at all fixed payments, all obligations, and of course we've got lease payments as well here. So it takes EBIT. Now EBIT is after lease payments, in particular operating leases. So we're going to add back the lease payments to the numerator to get earnings before interest, tax, and operating lease payments. And then on our denominator, we put our lease payments plus our interest expense. Again, it's a safety ratio. How comfortably are you meeting these fixed costs?